Hello, everybody. This is Professor Hassey, and this is our Week 7 review video. Today's date is Saturday, July 22nd. And what we're going to try to accomplish today with this review video is to review our one last look-see at assignment number 4, the capital budget analysis, go over a couple of things there and answer any questions that anybody might have. Then we're going to take a look at the final examination, which has been posted this weekend. That final examination is due on Sunday, July 30th, and is now posted and ready to do your work on. And that is now posted, and we'll review that for our class. And then we'll talk a little bit about the course concluding next week, what is involved in that, and what are your responsibilities and my responsibilities heading into the final week and closure of this class. So I'm going to speak a few minutes to go over a few things, and then I'll open it up for any questions that anybody might have on this fine Saturday afternoon. Now we have an assignment due tomorrow, which involves one of the key disciplines or key study of corporate or business finance, and that is the capital budget analysis, where a company has to determine the return on an asset investment with a variety of different variables. One variable is how much you are investing in the asset. The second variable is what is it costing you to get that capital to invest in that asset? What is the cost of the money? Because that cost is your discount rate in the return analysis. Another variable is all the variables involved with the particular investment. What's the life of the investment? How much are you depreciating that investment? What's the salvage value of that asset? How much revenue are you generating per year? What are your expenses and tax expenses per year? What is your net income every year? And then how much cash flow are you generating off that investment? This is one of the cardinal disciplines of corporate finance. Before you invest in an asset, is that asset going to be viable? And we use the four return vehicles to determine that: net present value, internal rate of return, profitability index, and payback. So you're doing this for assignment number 4. You're taking a look at these variables, and then you're placing them in a spreadsheet that I have provided you to determine the return of the asset. So your job as a student is to take these variables, which I happily give you them here, and place them over here. We practiced that. We practiced 2 problems last week, how to determine these calculations. We did a practice problem, how to determine these calculations. And your job is to put this together for assignment number 4. Now, as a review for this, I am now providing a file for you, which I will post to in-class review file folder in Blackboard week number 7. And that's this file here. This is another sample of the capital budget problem that you're doing in assignment number 4. It's a little bit different. Assignment number 4 was a 5-year investment. This is 7. The numbers are a little bit different, but the format and the analysis is exactly the same. Determining the investment in year 0, determining the revenue and expenses and cash flow for the life of the project. You're doing exactly the same thing in assignment 4. Your job is to apply this format and this analysis to assignment number 4, which shouldn't be that difficult, especially if you understand the concepts that we discussed in earlier videos about how to determine return analysis and cash flow. But let me walk you through this capital budget analysis sample that I have given you this afternoon. This is for an investment of $700,000. And the $700,000 investment is having a depreciable life of 7 years. At $55,000, excuse me, $100,000 a year depreciating. So for 7 years, we're depreciating the 700,000 at $100,000 a year in depreciation. Thus, the asset will have a zero accounting value at the end of its life because we fully depreciate it. For you accounting geeks out there, that's debit depreciation expense, credit accumulated depreciation every year for 7 years. This project of $700,000 investment is planning on producing 40,000 units a year. That's what they estimate. At a selling price of $45 a unit. And this selling price is going to be changed at 3% at the end of year one for the subsequent years. In other words, that's the inflation rate. We're going to inflate the cost 3% after year one. So notice what I did in the spreadsheet here. I took in year one, 40,000 units times $45 selling price to get $1.8 million in sales revenue. Then in years 2 through 7, I take the year one amount and inflate it by 3%. That's the inflation rate right here, 3%. So I just multiply year one times 1.03. So it's now being inflated by 3% increase in selling price. Thus, every year it inflates by 3%. So at the end of 7 years, you have $13.8 million of revenue you estimate generating off this $700,000 investment. Note the $700,000 is negative cash flow in year 0. That's today. You're spending $700,000 and you're selling that product here, and then you're expensing the product here. And what expenses? And I should type this out. That's not very fair, me giving that. That's variable costs. Variable costs are per unit costs of producing and selling this product. In this problem, the variable cost is $35 a unit every year. And that's being inflated at a different amount, which makes sense. Sometimes costs have different inflation figures than revenues, and that's being inflated at 2.5%. So now for variable costs, I'm taking 40,000 units produced every year times the variable cost per unit of $35, and I get in year one, $1.4 million of variable costs. And then I inflate that at 2.5% every year. Remember, the sales was inflated at 1.03 or 3%. Variable cost is being inflated at 2.5%, 1.025. And notice it increases by the inflation rate throughout the life of the project, ending up with approximately $10.6 million of total variable cost to produce this product. A second type of costs associated are fixed costs. Costs that are not determined by per unit, but generally expenses that have no basis of output. In other words, an example of a fixed cost is rent. I could produce 1 unit or 40,000. My rent's going to be the same. Insurance expense. Salaries of certain employees. Those are all considered fixed costs. They do not change in relationship to output. Well, in our problem here, it's given that fixed costs are $75,000 per year. And the inflation rate for those fixed costs is 2.5%. So now in the fixed cost line, I have 75,000 in the first year, and then I inflate that at 1.025 or 2.5%, every year to inflate those fixed costs, ending up with around $566,000 of fixed costs. Remember here, we're trying to determine the earnings before taxes of this product. Revenue minus expenses, variable cost, fixed cost, and don't forget depreciation. That's an expense. So we get earnings before taxes of $225,000 and so on every year. That's revenue minus expenses. From that, I have to take tax, earnings before taxes. So now I have to take, my tax rate is 25%. So now I have to take 25% of this number, earnings, to get my taxes. 25% of my earnings before taxes. I subtract that number from my earnings before taxes and I get my net accounting income. This project of an investment of $700,000 with a depreciable life of 7 years is going to generate almost $1.5 million in profit, net accounting income every year for the life of the 7 years. But that's not the number I need for my return analysis. I need net cash flow, not net income. How much cash is being generated by this investment of $700,000? Well, first of all, they tell me in the project variables that this project in year 7, I might add, that's the incorrect typo there, year 7, has a salvage value of $55,000. That means at the end of 7 years, I can dispose of this asset and get $55,000 in cash. Well, wait a minute, Mr. Hasse. I see $41,250 in year 7 as salvage value. Well, again, think back to your accounting days. If I have fully depreciated my $700,000 to the tune of $100,000 every year, that means I have fully depreciated the asset at the end of 7 years. So if I get $55,000 in year 7 as salvage, I have a gain on that disposal value. I'm going to have to pay tax on that $55,000 because I fully expensed it. This $55,000 is a gain on the disposal of the asset. So notice my calculation here in year 7 for salvage value. It's 55,000 times 1 minus the tax rate of 25%. So actually, after taxes, I'm getting 55,000 times 75% or $41,250. So whenever you see salvage value and you fully depreciate an asset, that means that salvage value is going to be a gain on the disposal and you're going to have to pay tax in the final year of the asset of that. But it's still additional cash coming in after we've paid the tax. It's $41,250. And as we've done in other problems, we're adding back in that $100,000 of depreciation. Why? We're not spending any cash here. It's an expense allowed by the Internal Revenue Service. It's an operating expense, but we're not writing a check for cash. So we add the $100,000 back in down here as positive cash flow. Salvage value after tax, adding back depreciation, and now the big kahuna, net operating working capital. It's under the premise of any investment in an asset that you're going to have additional cash needs as a result of that asset. Let me give you an example, and I might have used this in a prior video. If I buy a new car, I buy the car for its cost of purchasing it from the auto dealer. But does that end my investment in the car? No. I got to pay for insurance. I got to pay for maintenance. I got to pay for registration. I got to pay to bail my kid out of jail after he gets parking tickets. But I got to pay additional monies out for owning that asset. That's called net operating working capital. Now, all of that will be reimbursed to me as I start selling products that are being created by that asset. But I'm going to have to come up with upfront money to get that asset ready to be used to produce my 40,000 units a year. How do we calculate that? We're given the working capital rate based on next year's sales as being, in this problem, 9%. What that means is I'm going to have a cash outlay for every year of the project until I get to the final year based on 9% of my next year's sales. So look at the calculation in year 0. I'm taking 9% of $1.8 million, the first year's sales. That's negative $162,000 of additional cash that I need to prepare this project for its investment. So that means in year 0, my investment in the asset is not just $700,000, it's $862,000 negative cash to pay for the needed working capital to get this sucker off the ground. And then in subsequent years, remember, your working capital is 9% of next year's sales. Well, year 2, my sales are $1.854 million. Notice my calculation in year 1. I'm taking the delta of year 2 revenue minus year 1, the change, the delta. In other words, sales have gone up a $54,000 in additional revenue being received, mainly because of the increase in inflation. I take 9% of that delta and I get $4,860 negative cash. That's 9% of $54,000. So what does that mean? It means at the end of year 1, I have accumulated $166,860 of cash going out for working capital, which happens to be that total $166,860, 9% of $1,854,000. That's why this number is as it is. It's the delta between year 1 and 2. So this is the same for every year. In year 2, it's the delta between year 3 revenue and year 2 revenue times 9%, 5006. You can see that in the cell here. Same in year 3, 4, 5, 6. But wait, year 7, there's no year 8 revenue. The project is over. So now our working capital has technically been all reimbursed to us. And notice what I do in year 7 on this line. I take 9% of the year 7 sales, $2,149,294. I get $193,436, and that number will be positive cash flow. And now note this line of working capital. Negative cash, negative, 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 negative. And then it all comes back in the final year when the project is over. And notice the net of this line. It's 0. It's a wash. It's 0. The overall effect on the entire project is 0. But we're properly recording the cash needs in the years that we need working capital, and then in the final year when we add it all back in. People do this for a living. Amazing. So now we can do our return analysis, because now we have calculated our investment in year 0, $862,000 negative. And now in year 1, you take the net income add in depreciation, subtract out working capital, 263,890. The same for every year until we get to year 7 when it's a little bit different. It's net income plus the after-tax salvage value plus depreciation and plus the adding back of working capital. So notice in year 7, $588,746 of net cash flow. So now this investment of $862,000 in cash is generating $2.373 million of cash flow, not net income, cash flow. And that's the numbers we now use to determine our return, like we did last week. Notice in this problem, the weighted average cost of capital is 10.04%. So look what I do. I take formulas, function, net present value. I type in my working capital rate. In this example, it's 10.04%. And I put the values of cash flow being received in years 1 through 7. F21 to L21, years 1 through 7. So now this formula is taking years 1 through 7, $2.373 million of cash flow, and discounting it back at my cost of capital, 10.04%, and I get $1,578,560. And we always round. Professor Hasse does not like to see pennies in numbers. And there's my discounted cash flow, 1,578,560. If you were explaining this to me, you would say, Mr. Hasse, they're generating $2.373 million of cash flow. Here's my way I calculated it. And to take that cash flow and discount it back to today at 10.04%, that's actually a cash flow of $1,578,260. And that's how we get our net present value. The net present value is the discounted cash flow less the investment in year 0. That difference is positive $716,560. That's our net present value return analysis in dollars. Then I want you to calculate the internal rate of return. What's this in a percent? Formula, function, internal rate of return. There it is right there, IRR. What's this in a percent? Well, now I go to the values from including year 0 through year 7. I include year 0 in this calculation because I want to see what's the return. Oop, I highlighted that wrong. I picked the wrong line. Here we go. Year 0, there we go, to year 7, which is E21 to F21 or L21. What is this in a percent? Hit OK. Round, since this is a decimal, we round to 2 decimal places. 29.60%. That's my return in percent, 29.6%. So now I've calculated on this investment of $700,000 over 7 years, creating this cash flow, which you just created, a return of $716,000, a return at 29.6%, a return in a ratio called the profitability index, which is the relationship of the discounted cash flow to the net cash flow in year 0. What's the relationship of 1,578 to 862? Well, it's 1.83 times greater. That's the ratio of that return. And then finally, how long does it take us to get back our $862,000? Well, we took in 263,890. So at the end of year one, we still have 598,110 to be paid back. We took in 276,588 in year two. We still have 321,522 to pay back. We took in 289,805 in year three. Whoop, we're still not paid back yet. We still have $31,717 to pay back. Well, that definitely means when we take in 303,561 in year four, we're now paying back the 862,000 and then some at the end of year four. 1, 2, 3. Now, what portion of year four has been paid back? Well, that's easy to calculate. I just take the percentage of 31,717 to the cash flow of year four, 303,561. That's 10%, 0.1. 1, 2, 3.1 years. That's my answer. So that's the problem. You have now determined the cash flow of this investment, looking at all the variables, and you determined that this project is going to be a pretty good return on our investment. In today's dollars, we're making a little bit over 716,000. In percent, that's almost 30%. I can't think of too many investments these days that are making over 30%. The ratio is almost 2 times greater return than cost, and it's taking us almost 3 years to pay this sucker back out of a life of 7. This is the sample that I'm posting to week 7 that you can use to help you do assignment 4. But remember, assignment 4 looks like this. This is the spreadsheet that I gave you to do your work on. Notice it's only 5 years. Notice some of the variables and inflation rates are different. The tax rate's different. The working capital rate's different. The cost of capital is different. You have to apply these and do it here. That's your assignment. And then once you calculate NPV in dollars, percent, profitability ratio, and payback, would you recommend, yes or no, this investment of $750,000? That's assignment 4. I've given you this. That should say assignment 4, sorry. I've given you this. Now I've also given you a sample here and reviewed in this video. Lucy, this should help you.
Yes, I agree. I don't know if you're ready to take questions yet, though.
Just give me a minute.
Sure.
But that's what this review is about for assignment 4. I want to see this done by you here. You have to do all the formulas, the arithmetic, everything, but you see a sample that we just went over. Here. Questions, Lucy?
Okay. You have on this sample, on this sample, you have sales price per unit year 1 is not represented. Well, excuse me, let me go down. Gathering my thoughts. Okay. Expected inflation rate per year after year 1 is on the assignment number 4. Is that because it's duplicated twice on the spreadsheet for the assignment number 4? Is that first one supposed to be annual change in sales price?
I don't really understand your question, but let me explain what I think you're asking. In other words, in assignment 4, and the problem I just did, there's two different inflation rates. In assignment number 4, it's all the same. So selling price is going to be increased 4% after
Okay.
year one. Variable cost is going to be increased by 4% after year one. And fixed cost is going to be increased by 4% after year one. It's all the same. So
Okay.
it's not different. Like that's why you're going to college, so you can be able to figure that one out. That's why it's different inflation rates there. Here, I'm giving you a break. It's the same for each one.
Okay. I think the
Make
reason I
sense?
was asking the question because the language was different, you know, what you actually wrote in the cell as in comparison to the example. That's why I was asking.
What?
Because
Explain that to me again.
so line number 10 here says expected inflation rate per year after year one,
Yep.
4%. But in the example, you have annual change in sales price and then it has the percentage. So that's why I was asking.
Lucy, isn't that pretty much the same?
Yeah.
Okay. All right. And I'm not going to be a snob here, but again, we are training you to get a business degree because not every financial decision is the same.
hmm
Everyone is different. You as a student and as a business graduate, you should be able to realize, oh, this is the same thing. It's just the wording is a little bit different. I'm looking for an increase in price. So again, I'm not trying to sound like a snob, but you're being, if you go to a company and they have different ways of using different types of terms for variables, but the format and the bottom line is the same. You have to understand and feel comfortable with yourself and understanding, yeah, I know what they're doing here. That's the inflation rate. I don't care how they word it. I'm just increasing the price 3% or 4% every year because that's the way, that's common sense. You see what I mean?
Thank you.
Very good. Good job, Lucy. Any other questions?
I have a question.
Yes, sir. Yes, ma'am.
Okay. So in regards to the salvage value, I noticed in like the example that you gave us, it matches up in regards to the years that we're examining. But in our assignment, the salvage value is spread across 10 years instead of the 5 years, I believe, that we have in that example. So.
All right, that's a typo. That should be year 5. I'm sorry.
Okay.
That's 5. I'm sorry. That should be year 5. Thank you for Irish for telling me that. That's year 5. So it's exactly the same. Yeah, you're right.
Thank you.
Thank you. I'm an idiot. Thank you. Okay. Any other questions on this topic? Okay, good job. Now, if you need extra time this weekend to post later on this week, that's not a problem. If you need some more time to do this, especially after seeing this video, I'm sure it's going to be helpful to some students. Oh yeah, now I understand what the hell Hassie's doing. Now I can figure this out. I now have a sample. No questions? I will continue on. Once you complete this assignment 4 and post it, I have now posted our final examination. It is now in the final examination folder of Blackboard. It's a set of problems that you need to answer or multiple choice or your final portfolio spreadsheet. This is our work for the last week of our course. It asks general questions about the finance study that we've been in, and it asks questions about more of the recent topics that we've had in class. So this is the examination. You can do it all on this Word document or PDF document, but still remember, you have to post a spreadsheet for your portfolio work. And I'll talk about that in a minute. So your final examination is 3 parts. The first part, worth 50 points, is to answer the short answer questions. What is the difference between stockholders and stakeholders? We had a question on one of our assignments about that. What would the owners of a business, why would the owners of a business choose a form to form a corporation even though they will be face double taxation? What is the advantage of being incorporated? How much liquidity is a good thing? Do you want to have a lot of cash, or do you want to have some of that cash invested earning some type of return? Explain why the cost of capital is referred to as the hurdle rate in capital budgeting. Place the following in proper chronological order. Describe the purpose of each: ex-dividend date, record date, payment date, declaration date. Those are 4 key dates in a company allocating dividends to the shareholders. What's the timeline? What's the first, second, third, and fourth of these? And explain which each of them are. Here's one. Mars Company has net sales of $18 million. Next year, the company management expects a 15% increase in sales. If the cost of goods is 60% and inventory is 25% of sales, what would you estimate sales inventory to be and cost of goods sold in the next year? $18 million of sales increasing by 15%. So that's my total sales of the next year. 60% of those sales are cost of goods sold. That means the balance of those must be in inventory. What would you estimate the sales inventory to be at the end of the year and cost of goods sold to be? And then a question about determining the advantages or disadvantages of being incorporated, being in a business organization. Name and explain the different methods a corporation can distribute return to their stockholders. And this is a subject of chapter 17 of your text. What are the different ways that we can distribute dividends? Naturally, cash. What are the other ways of distributing dividends? If you go to 17.1 and 17.2 of your text, that's where that is explained. This is one that requires you to put on your thinking caps. Of these listed accounts, net income, dividends, and an increase in inventory, an increase in receivables, depreciation, increase in payables, increase in long-term debt, increase in fixed assets. Which of these are cash coming in? Which of these are cash going out? Give me a list of the statement of sources and uses. Net income, is that a source of cash coming in or a use of cash going out? Dividends, is that cash coming in or cash going out? Tell me what is positive cash flow and negative cash flow in this list of accounts. It refers to the statement of cash flows of a company, which we've looked at. Then finally, part 2 is some true and false questions. That's all they are, true and false, about capital budgeting, which you just did in assignment number 4. True or false, these 10 questions, true or false, as far as their statements are concerned in regards to capital budgeting. True or false, 10 questions. And then finally, as of this Friday, July 28th, the close of the market Friday, July 28th, not today, not Monday, Friday the 28th, I want you to revalue your portfolio, update your portfolio through July 28th, find the new stock price, find the new values of the Dow, the S&P 500, and NASDAQ. You've already done this before, and I believe assignment 3. Just update that through July 28th. 2 things you need to do. Include, has the company paid out any dividends during our course? You can go to Yahoo Finance and historical prices, and they'll show you when the dividends were paid out on your company during this last period. Remember, our class has gone from March to from April to now. Excuse me, from April, from June to now. So during that time span, did your company pay any dividends? And I want that listed in the dividend column on your portfolio. And then finally, again, like we did prior, how much did your portfolio gain in dollars and in a percent from the beginning of the course? From the beginning of the course to July 28th, what was the dollar value of change of your portfolio, and what was that in a percent? And compare that to the percentage change of the Dow, the S&P, and the NASDAQ. And the final question is, compare your percentage gain to the percentage gains of those 3 market indicators, and did you beat the markets? Did your portfolio outperform or underperform in relationship to the overall market averages during the course of our class? That's the final question, and that's a spreadsheet question for your class. And then when you get all done with this, by next Wednesday, here's a link to do a course evaluation about our course. And I'm sure a lot of you are so sick and tired of surveys, evaluations, blah, 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 from the University of Laverne. But this is one last thing you need to do. You don't need to do it. It's not mandatory. It's anonymous. It just helps Laverne get a good take on your value in this class. You don't have to do it. It does not affect your grade whatsoever. And there we have it. Now I want to show you one more thing in regards to this portfolio question. Let me bring it up. Okay. Here's our portfolio as of the last time we did evaluation, which is on June 30th. Okay. Notice at that evaluation, we included beta of the company. Now on July 28th, you're going to tell me any dividends that have been paid by your company during the life from June 9th to July 28th. This will now be July 28th. And you're going to update the price, which if you did your math correctly the first time and on June 30th, this will automatically change this, and you can get how your portfolio has changed. You're going to update these for the close of the market July 28th, and that'll update these. And in this portfolio of mine on June 30th, I outperformed the market. I had a 5.58% return on my holdings of Apple, Best Buy, Nvidia, and Disney, and I outperformed the Dow, the S&P 500, and the NASDAQ. Good job, Mr. Hassey. I don't think I've done that through July 28th, but we'll see. But that's what I want to see, your portfolio looking like this, showing your original valuation and the original start and the update. And now this will read July 28th, and update your portfolio with the new numbers and see if you beat the market. And remember, the student that has the best gain, the biggest gain, gets a little prize from Mr. Hassey as the Wolf of Wall Street. You get a University of Laverne gift, and you get a Starbucks gift card for the student that is our Wolf of Wall Street, who does the best. So this is good. And also the things that you've learned is, maybe I'm not that bad at picking stocks. Now I know how to keep track of them. And you can use this going forward, which is kind of helpful. I can't tell you, most of the things that students take out of this 8-week class, they forget within about 48 hours. But the one section that they really like and keep in there is the stock stuff. They now know what it means to invest in the market and how it grows, how it shrinks, how you compare it to other numbers, how you look numbers up. Oh, yeah, this is something that you'll use a lot of. Now, hopefully you'll use a lot of other stuff out of this course, but I know this is one thing that students take out of our course is, oh, now I know what this, when I hear on the news that my stock portfolio is up compared to the market, I know exactly now what they're talking about. So that's a good thing. So this is what I want you to produce as a separate file for your final this upcoming week. That's our final examination. I'll post this sample from assignment 3 into week 7 review files. So you have that in case you've lost track of it, just so you can see the format and see what I'm looking for. So look for that in week 7 portfolio as soon as this video is done. So a couple things you're going to look at to help you with assignment 4 and the final. You're going to look for this portfolio, and you're also going to look for this sample that I did today in this review session. That should help you do the work for assignment 4. Okay, so what's ahead? Well, first of all, let's go to our Blackboard here. Make sure we're all on the same page here. Here we go. So again, in the course syllabus, schedule, and information, there's another link to your course evaluation and when you want to get to that point and want to do it. And remember, we have roughly half of our grade still to be determined in this class. Your assignment number 4 is 20% of your course grade, and the final examination is 25% of your course grade. So in the next 8 days, 45% of your grade will be determined. So that's kind of important stuff. So that's why it's important to look over this video, make sure you understand what's needed, and be prepared. And boy, if you get an A on these 2, you're going to get an A in the class. You're in good shape. So that's just word to wise, what's left. I will post all the grades for this course by Friday, August 4th, and you'll see your course grade in Blackboard for this class. Secondly, if you go to the assignments and examination file folder, there's the final examination there in both a PDF and a Word format. And this is where you post your assignment 4 spreadsheet file this weekend as you complete it. And then in week 7, in the week 7 file folder, it's not there yet, but as soon as I'm done with this video, you'll see a file here, review files, which will include that sample assignment 4 file that we did today, and a sample of the portfolio and its format for the final. And then what we have left over next week, which is part of some questions on the final, is a review of financial planning, long and short term. That is in week 8, and there'll be a video for that posted this week, coming week. So you are up to date. Assignment 4, 20% of your course grade. Final examination, 25% of your course grade. Work on those this week. Information is in Blackboard, in your textbook, in PowerPoints, or even in this video that I'm talking about. If you have any questions or something looks strange, I'm around. You can ask me. The turnout for my review sessions on Thursday night has not been stellar, but that's okay. But I will be available this Thursday night for review if you have any last minute questions. Also, extensions are available for assignment 4 if you need them to post later, but there can be no extensions for the final examination. Everything has to be posted Sunday night. Now, naturally, if your computer blows up or something tragically happens, yes, you can have some extra time. But see, I have to get the grades in pretty quickly. And so that's why I tend to shy away from extensions for the final. Lucy and Miss Irish, I appreciate you coming on this Saturday. For the students who are watching this video, I know many of you are working or have family commitments today. Please watch this video. If there's any questions that develop from it, give me a shout out this weekend or next week. And I wish you much success in these final 2 assignments. Give them hell, and I'll talk to you all next week. Thanks, everybody, and I'll see you later. Thanks, Irish.
Okay,
Thank you, Lucy. I hope this helped.
Okay, thank you.